What's up, guys? Thanks again for checking out this podcast. Today's guest, I have a really, really special friend, and he's another loan officer within the industry. We started working together, working with the same company, and we just did an amazing conversation about refinancing, streamline refinancing. Is it a great time to buy? We had a really, really good conversation about whether you should work with a broker or a mortgage banker and what the differences are as it relates to the customer and picking a really good lender. So please join me in this conversation with Justice Roberts from Renown Mortgage. Thank you so much. What's happening, Justice?
What's going on, Pete? I'm looking forward to having a conversation with you today, man.
Yeah, it's kind of cool because I'm going to tell the story of how we met. Justice you live in Washington, where in Washington?
So a little south of Seattle in a city called Puyallup. It's like an old native tribe. And so, yeah, that's where I've lived and grown up my entire life.
So me and you met down in Costa Rica randomly. We were both at a mortgage retreat. And so Justice, you've been in the mortgage industry. You're a loan officer just like I am. How long have you been in the business now for?
In the business for 12 years, a little over 12 years, and got in as
So what is that, like 2012?
2012.
So yeah, so we met down in Costa Rica. We both are a part of a coaching group called L360. Shout out to Mr. Tim Brahim, who is our amazing coach that has coached both me and you. And so we met down there in Costa Rica, and then come to find out you have family that lives in Redding. And so you came down to visit the family for like a month. It's super cool. We've been hanging out now for almost 30 days.
Yeah, it's so cool. I think when I first met you, I was like, no way, you're from Redding. That's crazy because I've got family down there. And super cool how being down here for the last month has been, and getting to hang out, and I don't know, it's been a blast.
Yeah, and so what I also found out is that you had recently switched to going from, they call it banker or correspondent banker world as a loan originator and you switched over to broker. When I found that out, I was already in the process of applying to be a mortgage broker. And so this is what the topic of today's conversation is going to be, is what are those differences from the client's perspective?
Oh, totally. Super unique how it was a path that I was already on. And obviously just kind of as our relationship started to unfold, I'm like, there's so many similarities and connections. And that brings us to our conversation today of the mortgage broker model versus like what both you and I experienced on the retail side of a mortgage banker model.
Yeah, and you were a banker for the first 11 years?
Yeah, I've been in mortgage banking ever since I got into the business in 2012. So this is kind of a new world that we're kind of both embarking on together.
Yeah, so I think what I'll do is I'll start by explaining what the difference is. So can you explain what a mortgage banker is versus a mortgage broker?
Yeah, so in the most simple terms, I can say like a mortgage bank, they are set up and they have, whether it's warehouse lines, they have their different programs, but a lot of times it's kind of set specifically to for certain programs. So you probably have traditional conventional loans, FHA loans, VA loans, USDA loans, things like that. But it is through one specific lender. It's one specific bank through their investors that they kind of have set up. And the difference with that versus a broker side of things is you have a wide variety of different banks that all offer those exact same programs. Our job is a little bit more like mortgage matchmaking a little bit, which is obviously looking at things from a price perspective and what the consumer or the buyer or whoever you're doing the loan for, what terms you're going to be able to get for them, but also just as equally important, what guidelines are maybe applicable. So what's the scenario of each client and what's the loan that fits them the best, which I feel like is really unique on the broker side, is actually understanding enough about the client situation that you can actually find the right home for that specific borrower.
I found very similar conclusions looking at the two models. When I first got in the business, I started working for a broker, but it was for a very short time. And I think maybe a year when I got in, it was 2006. A year later, that broker basically went banker. He turned into a bank from broker to banker, and then he ended up crashing in 2007. And then that's when I was a mortgage banker. But so many years had passed, and the difference is then as a banker, because it is like what you said, they have their products and it's conventional VA. It's basically, your basic mortgage solutions, conventional FHA, USDA, VA, all those basic programs. And the process is easier is what I had thought, because you can use the same underwriter, you can use the same closer, and you have the same people that you work with along for that transaction.
Totally. It's interesting you bring that up. When I was making the switch for myself personally, I had one of my really good real estate partners that was just like, hey, like, what does this mean for our clients? What does this mean for what this experience is going to look like? Because they had some experience with brokers that were less than fantastic. Mm-hmm. And they're like, hey, it seemed like I've worked in these scenarios and like the lender is always like blaming the broker on, hey, sorry, XYZ isn't happening, or they added this condition last minute. Yeah. And the concern was there's going to be much less control as far as what that looks like. And my answer was very, very simple to him, which I feel like is a direct correlation. Is just like any industry, anything, you're going to have great originators. You're going to have, originators that are going to struggle. And I was like, it's all about the individual that you're working with. If you're working with a real estate agent who's a strong real estate agent, they understand the market, they understand what needs to happen, you're going to have a transaction that follows suit with that. Same as it relates to a lender. And I was like, the guy that you've worked with and referred your clients over, that's the same guy that you're working with. And it doesn't mean there aren't bumps in the road. Just like you and I are professionals, and like, this is our craft. This is what it is that we're really good at. We understand guidelines, we understand overlays, we understand client situations, and it's our job to actually navigate through that. So I was like, anytime you're getting a professional that's blaming an entity for what actually happened versus taking responsibility, that's the end of the conversation. We actually know what's different. And so on the broker side, it's like, you're still a strong originator, however it is that you set up. And if you understand how mortgage lending works, I think you're not going to see those drawbacks on the broker side that maybe others have experienced.
Yeah. So what I heard you say was that this individual that you were talking to, he was concerned because you're going to be working with all these other banks and that you may not have a streamlined process.
Absolutely.
And you might work with a bank that's dropping the ball on the file.
Absolutely. That was definitely the concern. And I think being able to actually answer that, and I think it's not just lip service. I'm not just saying something that is, sounds good so that it'll continue to refer clients over, but it's actually something that I stand by. And it's my commitment to my clients as we move through this process is like, I'm not changing as a professional. Like, I'm still going to do right by you. I'm not going to put you in a loan program that you don't qualify for. I'm not going to put you in a situation because I'm the professional.
I've told realtors this same thing. The loan officer is the professional. He should know more than the underwriter. The underwriters, all they're doing is following the rules. Whether you're working with a mortgage broker or a mortgage banker, all of the money's coming from the same place, which is mostly Fannie Mae and Freddie Mac, mostly. But as long as you understand the rules and what those rules mean, then you're going to be able to have your client have a really, really good experience, no matter if you're going banker or broker.
Absolutely. That's correct. I'd say there's one element, and this is always for clients doing their due diligence and knowing who they're working with, is that I think the broker model, based off of how it's set up, because there is significant price incentives, that it has attracted maybe a professional that is a little bit less qualified or maybe is not as seasoned in the business, which a mortgage banker, I've seen that, over time, or at least my history has told me in the last 10 years, that there's people that have built mortgage banking practices that really know their stuff. And so maybe that's brought a higher quality originator over time. But I think the broker model and things based off of technology changing and things like that, where there are so many originators like you and me who are kind of seeing the light, seeing an opportunity and how it can serve clients so much better without any of the drawbacks that have maybe been previously considered, that they're going that route. And so I think that you'll see more of that. But I would also say, with empathy to a real estate agent that it's experienced that, is that like they probably have had a bad experience with a broker, but that doesn't mean that brokers don't know what they're doing. It's all about the professional you're working with.
I think that you said that very good. That was said very well. I agree with you. What are some of the other benefits that you would say for a customer, for a client or a realtor that has for working with a broker versus working with a mortgage banker?
Specifically for me, I just love the idea, and I've loved the experience of flexibility. I mean, just being able to do right by the client in their specific scenario. Mm-hmm. And that sometimes means that you just have the right loan for that customer. However it is that you structure it, however it is that you set it up. I'll give you an example. So I have had first-time home buyers in the past where, they are maybe just able to qualify, credit scores in the mid to high 500 range. They're coming in at like a 580 credit score. And in a retail model, based off of how they're set up, a lot of mortgage banks have a certain appetite for a certain type of loan, and their loan is priced accordingly. They have a certain appetite. They're like, hey, these are the deals that we like. These are the deals that we see that are performing. These are the deals that our investors want. And so that correlates in price, where that limits a consumer just because they're coming to a mortgage bank at that specific price. That may not be the lender's appetite for that specific type of loan. However, in this model, every client scenario, so same client scenario we're talking about, let's just say it's a 580 credit score borrower that wants to, first-time home buyer that's trying to buy a house, there is a lender and a bank that wants that deal. They want that loan, and they are not only willing to approve it, but they're willing to give a good price for that, which I never had the flexibility on the mortgage banking side. It was like, hey, I just got to sell what I have. I just have to offer what it is that I have. In this scenario, it's like, who wants this deal and is willing to give me a great price? And so that disparity or the difference between the two loan options are drastic. And I'd say that it's two things. Number one, it's a better price for the consumer, but also number two, it might be the difference between being able to buy a home and not being able to buy a home. On the side of mortgage banking, if let's just say you're offering a certain interest rate that has a certain cost with a loan of that characteristics versus a bank that's going to offer it and give you a much better deal, that may be the difference of being able to close the deal. If closing costs and down payment and everything else in a retail model cost you $20,000 or $30,000 to get into the house, where you have another one that only costs $12,000 to $15,000, that may be the barrier of entry difference. It's like the difference between actually being able to close on a house and buy your first home or not. And so that type of benefit, I think, is just, it's hard to look away from.
One of the things I wanted to clarify, when you say price, that means lower interest rate and or lower cost.
Yeah, I'd say it's both. A lot of times it's both. It's interest rate and the cost for the loan.
And so what I heard you say is that a retail lender, they're going to have a specific appetite for a specific type of loan that they like. And it doesn't mean they want to rip off that customer that has a 580. It's just they don't necessarily want that customer in their portfolio, and so therefore they're going to price it accordingly.
Absolutely.
And so, and I agree with you, because I had worked with borrowers in the same situation, and sometimes it didn't work out, and they were able to get a loan with another. As a broker, we have the option as a mortgage broker to go to a bank that does have an appetite for that particular borrower.
Absolutely.
Which is amazing. Yeah, it's that's incredible. And then what are some of the other characteristics, would you say, or other benefits? I just made the switch just recently, coming out from 2006. It was like 15, 16 years, something like that, being in retail. And so I'm really enjoying this model. It is a little different on the origination side.
Yeah.
Yeah.
I'd say on multiple fronts, and maybe I'm being funny as I bring it up, but I think your originators are in better moods. Like, they've got more to laugh about and more to smile about, because there is, for someone that does well in this model, I think for me specifically, I found there's something that like matches my origination style. Instead of be required to say no, I always wanted to have a yes mentality with my clients. If somebody comes to me and they want my financial help to help them get into a home or, figure out their financing in some way, shape, or form, I never wanted to have to turn them away. And so I think this model gives us the ability to not only find the right product, have a great price for that product, but it's like, I have way more as it relates to multitudes of different types of products, whether it's renovation loans, construction loans. I get to work with real estate investors, and I have solutions for them, both short-term and long-term, any different type of like financing land loans. Like I've always been someone who has attracted I just want to help everybody in some scenario. If I've got clients that want my help as a professional, I'm not just limited to the certain product box that a mortgage banker, and like nothing against mortgage bankers. I think finding your lane, and I would say that there's originators that can do really well with like, hey, this is the type of loan that I'm really good at. For me, I love residential real estate. I love working with self-employed individuals. I love working with investors, and I have way more options as it relates to that when you just have a multitude of different banks to choose from.
The ability to offer a lot more for your self-employed borrowers, for investors, having a lot more options. In the retail model that I came from, it wasn't as plentiful as other investors, or as what we have as a broker?
From just the business side of a retail, mortgage lender, and on the banker side, like it's expensive and it's a layer of risk to be able to offer that many products, and businesses could not sustain themselves to do that. And so I think with this model for just a consumer looking for a loan and like going to someone that has access to all of those different options, I think is a huge benefit to them. And then as the originator, the more loans that I'm able to do, I'm able to provide for my family, and economically that is also a huge win.
Yeah. The other thing that I really is attractive to me by coming over to the broker channel is the transparency that we get with the price that you're talking about, with the cost and the price. And it's the money's all coming from the same place, essentially. As a retail loan officer, I found that it was challenging for me to sometimes understand what the total built-in margin was going to that bank.
Totally.
And so it was really hard sometimes for me to figure that out, the transparency of the pricing. That is something as a borrower working with a mortgage broker or a mortgage banker, and there's mortgage bankers that have great transparency. There's a lot of transparency, but I felt a lot more comfortable with what I was seeing as a broker with having all of the transparency there, knowing exactly what's built into that margin so that I can offer a really good price and a really good deal for my customer.
Absolutely. To that point, I would just say something that I learned, and this is actually from an old manager that I had in the mortgage space. And he was like, charge what you're worth and earn what you charge. And it doesn't necessarily mean that, like, I guess to that point of transparency, like do we as mortgage professionals make a good living and we have a great opportunity to do that, but doing that in a transparent way where the consumer's understanding what that looks like, and also you understand, so you actually know what you're actually selling to the customer and bringing to actually present to them and going like, here's the value in working with me. And yes, it has a cost as associated with doing that, but being in the dark, not understanding fully what that looks like, you're just kind of like misplaced. And it's like, where am I at? I'm just kind of like telling you what it is that I'm offering because that's all I have, and don't really understand what that looks like. The transparency, at least it gives me a new level of confidence behind the value that I bring to the market, and I think allows me to show up as a professional in a new way.
For customers that are deciding, between mortgage, if they're shopping around, let's say, what should they be thinking about?
Here's what I'll say, like, it's not always about price. So I think that knowing who it is that you're working with, I'll come back to that same exact point, is probably like the most important. Who it is that you're working with. Do you appreciate how they communicate, how they're able to explain things to you? Do they actually know what they're talking about? And are they able to answer the questions as it relates to your loan and situation. Like, are they able to answer that? But also being able, I think in this model, like very comfortable having conversations in regards to price and rate and terms and understanding that. I always kind of felt like I was a little bit embarrassed to bring that up because I knew I wasn't the cheapest priced in the market. And when that was the case, like that, obviously it was like, hey, how can I deliver value in so many other ways to actually quantify the offset for price? So I would still say I believe that value outweighs price. At the same time, being open to have those conversations in regards to price, so clients actually know what they're getting. But I think if it was like the first thing, like know who you're working with. Are they a professional that's going to be representing you in this transaction? This is the biggest transaction of your life.
Yeah. The other thing I would say too is if you're looking around, how vested is this individual, this person's loan officer, how vested are they within the community that they work in?
It's huge.
It's huge because if something goes wrong, the person that's online that doesn't have any relationships in that town, they don't care whatsoever if they get a bad rep or if they don't return a phone call or if they drop the ball. There's no accountability. Whereas me, if I have a client that's working here in town and something happens and I need to fix it, well, doggone it, I'm going to fix that problem because I have a reputation. And I want to keep that reputation.
Absolutely.
So that's a huge amount of value that you get from working with a local person, whether it's a mortgage banker or a mortgage broker.
100%. Yeah, I would say if you have the ability to go local, and I mean, I do business all over the country, so it's
Same.
so with that. But I would say if you're able to find someone that has that local presence, what a benefit, because you have that layer of accountability. You know, that lender is engaged with all the realtors in the same area, the appraisers, and like you mess something up, and it's like, hey, I know I could drive to your office, or you just have that level of accountability, and like they're vested in that community. They want it to thrive. And then obviously you have the other economic benefits of like supporting local business. You know, you're supporting that local lender. They're also going out and they're investing
Spending their money locally at the local restaurant. It's to keep the money local.
Absolutely.
Yeah, I definitely agree with that. What should customers be thinking about right now for their mortgage? Let's go back a couple of years. Anyone that bought a home in the last couple of years, should they be looking at refinancing? Should they refinance? So a lot of my customers, and I can tell you my opinion too, but like I'm curious on what your thoughts are on your past client database and what's happening right now, because a lot of customers are getting tons and tons of mailers. Tons of mailers. I had a customer just a couple of days ago. He brought in this mailer. He was a veteran. He's on fixed income and had a loan amount of like $350,000. And he brought in his loan estimate to have me take a look at it. And I was proactively watching his and talking to him. And he said, "Oh yeah, I'm talking to my servicer." They were charging him 3% up front, and only his monthly savings was only $150 a month.
Holy cow.
And so it was going to be a very, very long time until that loan recouped. There's a lot of customers that are getting solicited right now. What are your thoughts on that?
Yeah, I'd say that knowing that they're being solicited, and for people that are listening or watching, I'm just saying like, hey, you already know that it's hitting there. I would just say look at the loan and what the actual estimate is. What are they bringing to you as far as the actual loan offering, and understand that. And if you don't understand it, then reach out to Pete or or reach out to me. I won't be disappointed. That would be something like actually understand what you're getting and don't be distracted just by the shiny interest rate. Yeah. You know, there's a reason why, for marketing purposes and for all of that, the only reason they're able to actually offer and get you into a deal is because it's the shiny interest rate. But looking at the overall cost for the loan holistically is what you want. And I mean, honestly, if like you and I were comparing different loan estimates with, you know, from what a lot of these online lenders are putting together, it's like I would never put my customer in that loan. I think that's a terrible loan. It's a terrible structure, especially based off where the market's at. Because I mean, my thought process is we are going to continue to see interest rates come down over the next couple years. And that doesn't mean you should be staying in your same 6, 7, 8% interest rate that you've been at for the last couple years, depending on where you're at. But we can't handicap your financial future by tacking all this extra money onto your loan and taking that away. It doesn't make sense. Fast forward a year from now, 2 years from now, there's going to be another opportunity to refinance. And I don't want my clients being in a position to where we've added so much money to their loan that like, shoot, yeah, it makes sense to refinance again. But at the same time, you know, my loan balance has gone up by $10,000, $20,000, $30,000.
Yeah, they're looking at refinancing again, and before they paid 2 or 3 points to get that low shiny interest rate. Now they're looking at refinancing again and looking at another shiny low interest rate that cost you know, the same ish amount of money. The other thing I would say on top of that is that work with your mortgage person to see exactly when that recoup time is. When are you going to make back the loan amount that you increased by?
Absolutely. Yeah, that's a great way to underscore like the total loan cost. What's the recoupment? What's my cost benefit analysis, and what does that make my recoupment period? What does that make my break even period if I'm doing this deal with you today?
You want to make sure that you understand how to make that calculation, because that calculation, you don't just simply take the cost and divide it by your monthly savings, because you also have amortization built in. So you really need someone that knows what they're talking about that can show you exactly what that real recoup time is.
Absolutely. Yeah, you're spot on. It's not as simple as that. I think that could be an overly simplified calculation. And if your numbers make sense based off of that calculation, by all means, you're probably sitting good. But it's probably actually better than that if the loan structure is correct. Yeah.
A lot of customers, they think, well, I was told way back in the day that I should not refinance unless I get 2% lower on my interest rate.
Heard that so many times.
What are your thoughts
Well,
on that?
here's what I'll say. I'm like, I suppose it could matter if loan amounts were like $50,000, $60,000, $70,000. And I would say the market for a lower loan amount has to move further than it does for a higher loan amount in simplicity for the numbers to pencil and to make sense. But there is no calculation, 1%, 2%.
That works for everybody.
That works for everybody. It's your scenario. It's your loan amount. I'll tell you, if you have $1 million loan, interest rates do not have to move 2% in order for there to be a massive upsides in savings. And I think when you think about it, as far as the math goes, you're like, oh, my savings, if interest rates drop 1/4 or 0.5% on $1 million, that's hundreds of dollars a month. So I think everybody's situation is unique. Looking at the amortization, I've even had conversations with people now where they're okay with the monthly payment that they're making right now, but we're looking at moving them to a different amortization. So moving from a 30-year to a 15-year.
They take that monthly savings and then they just keep making that same payment because they feel comfortable about making that current payment. Interest rates drop and boom, they keep making that payment. Now we just cut their amortization down 10, 15 years.
It's twofold. You're paying less for the house because interest is lower because you're dropping the rate on that. And then also you're paying that much extra towards the principal every month. And so it's like a double whammy as far as an improvement in their scenario.
You want to explain what a lot of people are that bought in the last couple of years got a FHA loan. So any of our customers that got a FHA loan recently, they're getting tons of mailers on a Streamline. You want to explain what a Streamline?
So an FHA Streamline, really cool loan product. What's super, super unique about this is that pretty much FHA, the way that they underwrite the loan is as long as you've made payments for the last 12 months on time, then you're eligible. There are some important things. There have to be enough net tangible benefit, which means you're going to have to save enough money for us to be going through the fact to do this loan. But if if all those numbers check out, it's an easy way without doing an appraisal, without doing any income verification. So it's like the easiest loan ever. And even if situations has changed for your job or things like that, it just has no impact. You're able to drop the interest rate from where you're currently at to a new mortgage, very, very, very low cost in comparison to maybe
no appraisal. There's no appraisal required. There's no income required. There's no credit required, although you do have to show a payment history on that mortgage.
Correct.
You have to show that you made your payments on time or since you've had the mortgage or for the last 12 months.
Absolutely. So you've got that. And I mean, there's some slight nuances with it as well, is that you are bringing some funds because your loan balance barely goes up because the only thing that's basically allowed to be financed back in is the mortgage insurance payable to directly to HUD. But you have, some of those closing costs that you're going to have to cover. But if you look at the math and like they can hop on the phone with you or me and we could break down the scenario for them specifically. But a lot of times based off their cash flow over the course of a couple months, it's a complete wash and all they're doing is dropping their mortgage payment down and based off of payments that they're not having to make, escrow refunds, all of that sort of stuff. It becomes a huge win for so many people to do a loan that is not only is it easy, probably the easiest loan you've ever had to do, but paired with that, it's also a super, super low cost loan and a great way to drop the mortgage payment.
I have a lot of people that are streamlining right now, and a lot of people get these mailers on Streamline, and a lot of people don't understand, or a lot of people don't realize that almost every loan has the ability to streamline aside from conventional. So you have VA allows you to streamline refinance. They call it an IRL, interest rate reduction refinance loan. And then they have FHA Streamline. They have USDA Streamline refinances. And so if you have one of these loans, you should definitely reach out to Justice or myself, and we can definitely walk you through how this actually breaks down.
Absolutely. Yeah. Love to break that down, go over the math, and just actually help you consider whether or not it makes sense.
Yeah. I'm also curious on what your thoughts are with interest rates. And I heard you say that you believe interest rates are going to continue to come down. We've seen a little bit of a spike up a little bit here, but I have clients right now that, are like, hey, Pete, I kind of want to wait to see and wait for interest rates to come down a little bit more before I pull the trigger on this, right now monthly savings.
Yeah, I'd say the timing of it matters, but I think the education and thought process, I've been having a lot of similar conversations with a lot of my clients. And I think it's holistically understanding their situation, but then also looking at the market and looking at the math. I talked with a client this morning and we were talking about what's the cost of waiting if we don't refinance, because you have to think about if we're not refinancing today, we're also missing out on the savings that we're able to capitalize on today.
Next 2, 3, 4 months. Yeah.
And so if interest rates trend down over the next several months or into the next couple years, if you're paying 6, 7, 8% and you can get a much lower interest rate, what's actually the savings that you're missing out on, and forecasting that into the future? Because maybe you can save an extra $100 a month, but that is 12 months down the road before you're going to save that extra $100, $200 a month. So my question would be, how low do you think interest rates are going to go, and how long do you think it'll take to get there? Which I have clients that are like, well, I don't know. That's what you're supposed to tell me. But at the same time, it's like, that brings it up. It's like, well, none of us really exactly know, which is why doing the math based on your scenario today and structuring a loan that makes sense so that we're not handicapping you in the future. We have such a short recoupment period, so we're doing a loan that makes sense in an environment where interest rates are going down.
Yeah, so what I heard you say there was it depends on the situation with that customer, and they should really take a look at not just what they're going to save by waiting potentially, but also what they would lose on paying that higher interest or higher cost over that period of time of waiting for that specific interest rate to get there.
Spot on.
Yeah, I definitely agree with you for that. I think that also depends on the customer's situation too. So like if someone's planning on maybe moving in 1 year, maybe it's not the best time, or maybe they should not refinance, or, depending on their situation, if they are okay with, waiting a few months. And it just depends on what's happening, with that particular customer.
100%. I think you got to take every scenario, every family uniquely to their situation, because as you put it, like if someone's going to be purchasing a home in a year or in 6 months, and right now they're currently occupying their home, terms are going to be so much better if you're financing the house as a primary residence when you're living in the house. And so if you're refinancing now while you still own the property, like don't pay higher interest and then, move and then go, oh, I'm going to go try to refinance that primary residence loan, because now it's a rental loan. Now it's an investment property loan. So terms, you're going to be offsetting that, based off of where the market's at. So it may be, again, there's no one size fits all in this industry or for every family. Everybody runs their finances different. Everybody has a different scenario, different plan. Hey, I'm going to switch jobs, and go self-employed, next month. Maybe we should be looking at how we can get you qualified for a loan before you change, everything around.
So what I heard you say, there's two things there. The first one was if they know they're going to go self-employed, if they're going to be making a big job change, for sure, take a look at that refinance, because you can get that payment lowered. You may have maybe a longer waiting period to recoup, but it might make sense because you are taking that big leap into self-employment, because you're at least 2 years out before you can get another mortgage.
Absolutely.
The other situation I heard you say was if you plan on turning this house into a rental property and you want to buy another primary in the next couple of years, well, now would be the great time to do the refinance, because you can take advantage of the lower interest rate right now. Don't wait until you want to purchase, or maybe you purchase and then refinance later, because on an investment refinance, if it's an investment property, that interest rate is going to be at least 1% and a lot more expensive, higher than what they could as a primary.
Absolutely. That's just where knowing your situation, and when you work with someone who's like, hey, what are we actually considering here?
Yeah.
I think the biggest challenge, and I'm like, don't want to beat up too much on online lenders, so to speak, but like majority of those people are about the deal. It's about, how can I get a deal in? How can I meet my quota? How can I go out and get another paycheck or get an additional commission, versus working with someone who's actually going to try to make a decision for you based off your family and your scenario. And that's the biggest difference, right? You have someone who's going to look at what you're aiming to accomplish, look at the market, piece all that together and go, here's what actually makes sense for you. And here's why we would do it, or here's why we would wait. Here's why, it makes sense. And here's why it doesn't. And being able to actually be honest. I mean, that's what everybody wants. They want somebody who's going to leverage their expertise in their industry to actually make a beneficial impact in their family.
What are your thoughts on appreciation over the next year, 2 years, 3 years? What are your thoughts on if someone's on the fence, if they're a first-time buyer? Do you think that they should get in as soon as possible? What are your thoughts on just the overall general real estate market?
Man, there's a few different thought processes. I mean, the first one I'll take is first-time home buyers, or somebody that's maybe renting or getting into the housing market. I'd say our current market benefits first-time home buyers the most. And if I rewind a few years, go back to 2020, 2021, which I think is the level of intensity as interest rates continue to come down. I think we have multiple bidding war options, and like that's what's ahead. It may not be to the same level or degree, but the biggest people that that were hurt during that time, in my opinion, were first-time homebuyers. They were the ones who like didn't have the cash to be able to compete with other people that were putting as much money down and could afford to go above and beyond list price. And so I think those are the demographic that got hurt the most, which means that I think that they are the, right now the first-time homebuyers have the biggest opportunity. I tell first-time homebuyers this all the time. Your first home will be the hardest home you ever have to buy. Like once you get into the market, once you get into your first house, things get easier from there. You've built equity over time and you have the ability to leverage that to get into your next deal. So you might feel like it's a lot to put 3% together. I get it. I was there one day, not too far back in the rearview mirror. At the same time, like if your first one's going to be the most difficult, typically getting into that first house with zero down programs where sellers are actually open to that, putting 3% down where you can actually still compete. Sellers maybe are willing to offer concessions to help you get into a house. It's a much easier barrier to entry. And I think that's a huge benefit. As far as like home appreciation and everything else, all the data is pointing that even in our current interest rate environment, homes from a national perspective and most local perspectives are still appreciating steadily. And so I've saw some different reports out recently that so far, like this year, we're on track for like 4.5% to 5% appreciation. That's not too bad in a good market. And I think that all of that, especially with our limited supply for where home inventory is, that we're going to see quite a bit more of that as interest continues to come down lower. They've done estimates where if interest comes down, I think it's a full percent, then 1 million more home buyers in the country are going to be adding in. And if you think about just simple economics, supply and demand, right, where you see that much more competition that it's going to bring, which is going to pressure home prices up. It's great if you own the home. If you're on the other side where you're like, hey, interest is lower, but now I'm having to compete and actually pay more for the house. You're obviously on the other side of the coin.
Yeah, what I heard you say was, and I remember this in 2020 and 2021, you had first-time home buyers that just could not figure out how to get into the home because there was so much demand, so many people that wanted to buy. Everyone that was putting offers in, a lot of them had maybe cash, or a lot of them had equity from another house they were selling, or it was that second, third home that was easier for them because they had a down payment. But those first-time home buyers, there's a lot of first-time home buyers that were able to, but they paid $20,000, $30,000 more on the home than what they, in a market like this, wouldn't necessarily have to. To make it simple for a first-time home buyer, which world would you want to live in? Would you want to pay an extra offer on a house where there's 5, 6, 7 offers and you're having to go $10,000, $20,000, $30,000 over the asking price? Or would you rather pay a little bit higher interest rate and get the home for what it's costing today and not having that bidding war? Again, it's not this, like what you're saying earlier, it's not everyone's going to be different. And so, I don't think there's a right or wrong answer, particular for first-time home buyers, but it's not a bad move to make the jump and buy your first home.
100%. I think looking at your situation specifically, like getting into a house, doesn't mean that it makes sense for absolutely everyone, because financially, some people may not be ready in this economic environment. They might not be stable enough in their job. They may not have enough income where this actually makes sense. They may have some things that are going to be changing. Maybe they're thinking about moving somewhere else and moving out of the area. Maybe all those other variables mean it's not the right time, and that's okay. Yeah. However, if you were to look at it specifically based off the market and you're qualified in both markets, I think it's a much better idea to purchase now, because you lock in a specific price for a home based off where things are at. You can always change the terms of the loan later.
I think a lot of first-time home buyers will benefit from this conversation that we're had to actually help them make that decision one way or the other, whether they should pull the trigger or continue to find a better time for them to purchase, right?
Absolutely.
The election's coming up. And I don't want to get too political, but there's a lot of people, I think, that are uncertain, and it's kind of an uncertain time. And this happens every 4 to 8 years, or every time we have an election. I think people are on the sidelines, sitting around, not necessarily making big financial moves like purchasing a house. What are your thoughts on that situation?
Yeah, I think having a little bit of context to have been in the industry long enough to be having conversations, I've noticed a pattern over time with clients that around these types of elections, presidential elections, that there definitely is uncertainty, and it's like, what's going to change? And for me, I think that it's number one, understanding and having empathy. Like, I totally get it. I think that's, where it is that I start, that there is some uncertainty that's there. And then, my curiosity leads me to ask a question like, what do you think is going to happen? What do you think that means to you and your family? Sure, things change, but like, what does that mean like for your business, or what does that mean for your family? For your employer, does that mean that you think you're going to lose your job? Does that mean that you feel like you're going to have your hours cut? Does that mean that you think that the world's going to collapse and crumble and everything ceases to exist because one party gets elected versus the other? And I'm kind of being cheeky with that, but as I've kind of probed a little bit further, I think the question actually comes is like, I'm really not sure what I'm afraid of. I'm afraid of the unknown. And I think where I can have empathy and understand, that seems to be a very, I don't know, not the place I'd recommend making, strong decisions from. And I can understand where people are going, well, I don't actually know what to expect, so I'm going to wait. I'm going to put off what's there. Mm-hmm. And I would say that the benefit of that is that there's probably a lot of other people doing the exact same thing. And when everybody else gets on the other side and they realize that the world is still moving, I still have my job, the economy's still going, everything's still happening. Now I'm going to get on the other side and I feel like, okay, we'll go put the offer. Well, if you act before then, while everybody else, because if you pull yourself out of the emotion and look at it from a logical standpoint, you're like, life's not going to change that much. And if the world implodes, then like, we don't really have to be worrying about the fact that you bought a house or not. We have much bigger things to consider at the end of the day. And so transitioning from that, I mean, I've had many conversations. It's like, how do we understand? And people are leading with their emotion, and I totally understand that. Yeah. And I think that, I mean, in simplicity, I don't think that there's a whole lot of logic behind that, and that's fine. Like, we're human beings, and that is what it is. But I think at the end of the day, election's going to come. It's going to go. Life is going to continue to keep going on, and there are going to be impacts over time based off of monetary policy changes and economic changes depending on which party. But is it going to make a massive difference based off of what home appreciation happens, what happens with your job and in your local market directly? I think that that's probably given a little bit more power to a political candidate than they actually have.
I agree. At the end of the day, people are going to still need housing. People still need a roof over their head. People still need to provide for their family. And so life's going to go on. Anything else that you want to talk about?
Man, this has just been a great time. I appreciate you having me. It's a great time just hanging out and talking the mortgage industry, talking like things that I get to talk with clients every single day. And I think it's cool to share in kind of a forum like this. I think it's cool understanding the market, really demystifying kind of like what happens behind the scene in the mortgage business. What does the market look like? And I think that, if there's one message that I would want people to hear is like, it's not as scary as you think it is. Like, do you remember back to the day when you were first learning how to drive a car? And, I remember it was kind of scary. It was like, you're trying to think about all these different things. How do I remember to signal and look left and look over my shoulder and, look in my rear view mirror and everything else? And understanding that's like, of course, it's going to be a little bit scary the first time that you're doing something, but realizing that it doesn't have to be that. And what's unique and what's really cool about this business and why I love it so much is that I get to come along people that haven't done it for the first time or want a unique perspective because they've had a bad experience, that I had someone who always just did it for the deal, and having someone who represents them as someone who actually cares about their situation, wants them to make an informed decision and wants to actually learn through the process, that it doesn't have to be that scary. It doesn't have to be something that you don't do because you don't understand, or that you kind of feel like all this pressure to do, but you don't really understand what you're making a decision on. And so to collaborate with someone and to feel like you get to be an advocate for someone as they move through this process, I think is just a huge joy. And that would be my encouragement, is like, don't be afraid of mortgages. Don't be afraid of buying a house. And don't be afraid of taking action in maybe an uncertain time. So that's my message today.
I love it. And don't be afraid to ask questions. So Justice, dude, thank you so much. The other thing I didn't actually talk about is we met down there, and we've been working together, and bro, I've learned a lot from you over the
thank you, bro.
3 or 4 weeks, and we now work for the same company, and I'm super excited to work alongside each other, basically cheering each other on. So super, super meaningful for you to be here and for you to have done this with me. So thank you
Absolutely.
very much. If someone wants to get a hold of you, how do they get in touch?
I mean, reach out if you want to look on social media. I'm at Justice Loan Officer, so that's nice and simple. If you want to get a hold of me directly, our office, you can call 206-326-1802 and reach out. We love to have a conversation. We love to get to know people. And whether you're someone in the mortgage industry, you're someone looking for a loan, real estate agent, anyone that's in the industry, and you just want to learn, you want to start investing, like, we'd love to have a conversation and just be an advocate for you. Thank you, bro.
Thanks a lot, bro.
Absolutely.
Super cool.